Last week, I watched my portfolio drop 8% in a single day. Maybe you felt that pain too. The headlines are everywhere. The risk of recession just increased significantly. Markets in freefall as recession fears mount. How worried should you actually be about a recession? The fear is real. But here's what the financial news isn't telling you. Recessions aren't just periods of loss. They're also the greatest wealth-building opportunities of our lifetime. The ultra-wealthy know this secret. Economic downturns are when the real fortunes are made. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Today, I'm going to show you exactly how to apply this wisdom with 6 specific ETFs that the wealthy use to not just survive, but actually profit during economic downturns. These aren't just random picks. They're strategic investments backed by decades of recession data. By the end of this video, you'll have a clear roadmap for transforming market panic into long-term wealth. And the best part, you don't need to be a Wall Street insider to implement these strategies. Before we dive into specific ETFs, let's understand what happens during a recession and why most investors get it completely wrong. Right now, we're seeing unprecedented S&P 500 volatility that feels terrifying. VOO dropping like a rock, QQQM plummeting, even safer dividend ETFs taking serious hits. This market behavior triggers our deepest financial fears, and that fear leads to panic selling, the exact opposite of what wealthy investors do. History has shown us that recessions are temporary, but the wealth created during these periods can be permanent. Look at the data. Investors who bought quality assets during the 2008 financial crisis saw returns of over 400% in the following decade. Those who purchased during the COVID crash of 2020 doubled their money in under 2 years. The secret isn't timing the exact bottom. It's having the right assets in your portfolio that can weather the storm and position you for explosive growth during the recovery. Time in the market always beats timing the market, especially during recessions. What I've learned both personally and professionally is that most investors focus entirely on what to sell during economic downturns, when they should be strategically deciding what to buy. Today, I'm going to walk you through the exact ETF categories that can not only preserve your wealth during market turbulence, but potentially grow it significantly. I've been implementing these exact strategies in my own portfolio, and they've transformed how I view market corrections. Remember, recession fears often create irrational market behavior, which creates extraordinary opportunities for those who understand where to invest. The wealthy have used these 6 ETF categories for decades to protect and grow their wealth regardless of economic conditions. Now it's your turn to access these same powerful tools. If you're ready to transform market fear into financial opportunity, hit that like button and subscribe now to join thousands of smart investors who are preparing, not panicking, during these uncertain times. ETF Category 1. Gold ETFs. Throughout history, when economies falter, one asset has remained a beacon of stability: gold. There's a reason central banks around the world continue to stockpile gold reserves. It's the ultimate financial insurance policy. During times of market turmoil, uncertainty, volatility, and fear, gold doesn't just survive, it often thrives. When stocks crashed during the 2008 financial crisis, gold surged over 25%, while the S&P 500 lost nearly 40%. During the COVID crash, gold remained remarkably stable as markets plummeted. This pattern repeats throughout financial history, gold zigging when markets zag. A commodity like gold serves as the safest asset for investors during unpredictable market conditions. This is why many financial advisors recommend clients allocate a small portion of their portfolio to gold, not just for the potential appreciation, but for true diversification. Gold's correlation to stocks and bonds is remarkably low, creating a genuine hedge against uncertainty, where you can preserve and even grow your capital. My favorite gold ETF is IAUM, the iShares Gold Trust ETF. IAUM seeks to reflect the performance of the price of gold while offering investors a cost-effective way to access the gold market. The expense ratio is impressively low at just 0.09%, making it one of the most affordable ways to add gold exposure to your portfolio. The returns have been nothing short of remarkable. IAUM has beaten the broader market recently, with over 16% annual returns across the last 3 years. For alternatives, I also like BAR, the Granite Shares Gold Trust, which offers similar gold exposure with a competitive expense ratio. Another solid option is FGDL, the Franklin Responsibly Sourced Gold ETF, which provides a slightly different approach to gold investing. What makes gold ETFs particularly powerful during recessions is their liquidity. Unlike physical gold, which can be cumbersome to buy, store, and sell, gold ETFs trade just like stocks. You can buy or sell instantly during market hours. This makes them ideal for strategic portfolio adjustments during volatile periods. For most investors, I recommend allocating between 5 to 10% of your portfolio to gold ETFs as a recession hedge. This provides meaningful protection without sacrificing too much long-term growth potential. Remember, even Sarah, a client who initially resisted gold investments, thanked me profusely when her gold allocation helped her portfolio remain stable during the last market correction while her friends were panicking over their losses. ETF Category 2. Dividend Value ETFs. While other companies cut dividends during downturns, certain resilient businesses keep the cash flowing to shareholders no matter what. This is the power of quality dividend stocks during a recession. When market prices are falling, these dividend payments become even more valuable, providing you with steady income when you need it most and giving you cash to reinvest at bargain prices. Dividend ETFs shine during recessions because they focus on high-quality companies with strong balance sheets, stable earnings, and long histories of maintaining payments through economic cycles. These aren't speculative growth stocks. They're established businesses that generate substantial free cash flow in any environment. During the 2008 financial crisis, while many companies slashed dividends entirely, the aristocrats in these dividend ETFs maintained or even increased their payouts. The compounding effect becomes even more powerful during market downturns. When you reinvest dividends at lower share prices, you're essentially buying more pieces of great companies at a discount. This dividend double dip can dramatically accelerate your wealth building when markets eventually recover. My top recommendation in this category is SCHD, the Schwab U.S. Dividend Equity ETF. Think of it as investing in the gold standard of dividend ETFs, especially for recession protection. SCHD tracks an index focused on quality and sustainability of dividends, not just high yields that might get cut when times get tough. SCHD currently offers a substantial dividend yield of around 4%, with an incredibly low expense ratio of just 0.06%. What makes this ETF truly exceptional is its sector allocation heavily weighted toward recession-resistant industries: energy, consumer defensive, healthcare, and industrials. Its top holdings include companies that have thrived during previous downturns: ConocoPhillips, Chevron, Coca-Cola, Bristol-Myers, and Altria Group. What's most impressive about SCHD is that it actually grew its dividend every single year, even during the 2020 market crash, demonstrating extraordinary resilience. This isn't just talk. The performance numbers speak for themselves. SCHD has returned over 17% annually over the last 5 years and over 11% over the past decade. For alternatives, VTV, Vanguard Value ETF, offers broader exposure to value stocks beyond just dividend payers, while HDV, iShares Core High Dividend ETF, focuses more exclusively on higher-yielding companies. I've seen firsthand how dividend investing transformed my client Mark's outlook during the last market crash. While his growth stocks were plummeting, his SCHD position not only held up better, but continued paying him every quarter. This steady income stream gave him the confidence to stay invested and even buy more when others were selling in panic. For most investors, I recommend allocating 15 to 25% of your recession portfolio to quality dividend ETFs like SCHD. ETF Category 3. Balanced ETFs. What if I told you that billionaire Ray Dalio created a portfolio strategy that's weathered every economic storm since 1996? This isn't hyperbole. It's the remarkable story behind our next recession-fighting ETF. Ray Dalio, the legendary investor and founder of Bridgewater Associates, created what he called the all-weather portfolio, a strategy designed to perform well in any economic environment: boom, bust, inflation, or deflation. For decades, this revolutionary approach was only available to Dalio's ultra-wealthy clients. His hedge fund required massive minimum investments far beyond what average investors could access. But everything changed when State Street Global Advisors packaged this strategy into an ETF called ALLW, making Dalio's brilliance accessible to everyday investors like us. The genius of ALLW lies in its meticulous balance of uncorrelated assets. Unlike typical portfolios that collapse when stocks fall, the all-weather strategy maintains stability through true diversification. Here's the breakdown of what makes this ETF so special. It allocates 30% to stocks, split between US and international markets, providing growth potential without excessive risk. The core defensive component is a 40% allocation to long-term bonds paired with 15% to intermediate bonds, creating a robust stability foundation. Then comes the inflation protection, 7.5% gold and 7.5% commodities, precisely calibrated to guard against rising prices that typically hurt both stocks and bonds. What makes this approach distinctive isn't the individual components, but how they work together. When stocks fall during recessions, the bonds typically rise. When inflation spikes, the commodities and gold provide protection. This isn't random diversification. It's strategic asset allocation based on understanding how economic forces affect different investments. The expense ratio for ALLW is 0.85%, which is higher than simpler ETFs, but still dramatically cheaper than accessing Ray Dalio's strategy through a hedge fund, which would charge 2% of assets plus 20% of profits. For comparison, that would be like paying $20,000 annually on a $1 million portfolio versus just $8,500 with ALLW. While ALLW is ideal for any investor seeking balance, it's especially valuable for those approaching retirement, those with lower risk tolerance, or anyone who wants to sleep peacefully during market turmoil. I've recommended this strategy to clients who were previously checking their portfolios anxiously every day during market drops. They now tell me they barely react to market headlines anymore. You can think of ALW as a one-stop recession survival kit that doesn't sacrifice long-term growth potential. For most investors, allocating 20 to 40% of your portfolio to this strategy provides substantial protection while maintaining participation in eventual market recoveries. ETF Category 4: Bond ETFs. While everyone else panics, bond investors sleep soundly, knowing their capital is protected. Bonds are the unsung heroes of recession investing. They might not make for exciting conversation at dinner parties, but they've saved countless portfolios during market meltdowns. When stocks plunge during recessions, quality bonds often move in the opposite direction, providing critical stability when you need it most. Bonds work as a low-correlation asset to stocks, serving as a flight to safety for investors during market turbulence. When fear grips the market, money rushes into government bonds, particularly U.S. Treasuries, which are backed by the full faith and credit of the U.S. government. This reliability makes them the financial equivalent of a storm shelter during economic hurricanes. The bond math is fascinating during recessions. As interest rates typically fall during economic contractions, when the Federal Reserve tries to stimulate the economy, existing bonds with higher rates become more valuable. This creates a potential double win. You receive steady interest payments while also seeing the principal value of your bonds increase. My top recommendation in this category is VBIL, Vanguard 0 to 3-month Treasury Bill ETF. This relatively new Vanguard offering provides exposure to short-term government bonds with an impressively low expense ratio of just 0.07%. The current bond yield sits at approximately 4.2%, which is remarkable considering the safety profile of these investments. In today's environment, earning over 4% on extraordinarily safe assets is a rare opportunity. I prefer short-term bonds over long-term bonds during uncertain economic periods because they carry significantly less interest rate risk. If inflation surprises to the upside or rates rise unexpectedly, short-term bonds will recover much faster than their longer duration counterparts. For alternatives, SGOV, iShares 0 to 3 month Treasury Bond ETF, offers ultra-short duration exposure, while BIL, SPDR Bloomberg 1 to 3 month T-bill ETF, provides similar benefits with slightly different implementation. The most common misconception I hear about bonds is that they're boring or for retirees only. This misses their crucial role as portfolio stabilizers. During the 2008 financial crisis, while stocks were crashing over 50%, Treasury bonds actually gained value. Having a portion of your portfolio that zigs when the market zags isn't just for safety. It provides you with dry powder to reinvest at bargain prices. For most investors facing recession concerns, I recommend allocating 15 to 30% of your portfolio to short-term bond ETFs like VBIL. This creates a meaningful safety net without sacrificing too much long-term growth potential. The exact allocation depends on your risk tolerance, time horizon, and overall financial situation. ETF Category 5. Consumer Staples ETFs. While luxury spending plummets during recessions, these companies sell products no one can live without. Think about it. When economic hardship hits, people might delay buying a new car or cancel vacation plans, but they'll still purchase toothpaste, soap, medicine, and groceries. Consumer staples companies make the products that remain in shopping carts regardless of economic conditions. The psychology of consumer behavior during downturns creates a remarkable stability for these businesses. Unlike cyclical companies that see wild swings in revenue, consumer staples maintain steady cash flows. This translates to more predictable earnings, sustained dividends, and significantly less price volatility during market turbulence. It's not that these stocks never decline during broad market sell-offs. They do, but they typically fall far less and recover more quickly. My top recommendation in this category is VDC, the Vanguard Consumer Staples ETF. This fund gives you exposure to 103 companies that provide essential consumer products across America. With an expense ratio of just 0.09%, VDC is an incredibly cost-effective way to add recession resilience to your portfolio. It currently offers a solid dividend yield of approximately 2.4%, providing meaningful income even during market downturns. What makes VDC particularly powerful is its portfolio of household names that dominate their industries: Costco, Walmart, Procter & Gamble, Coca-Cola, PepsiCo, and Philip Morris International. These aren't exciting tech startups. They're established companies with massive distribution networks, beloved brands, pricing power, and decades of experience navigating economic cycles. Let me take you on a quick mental shopping trip through a typical American household. The toothpaste in your bathroom? Likely Colgate or Crest, owned by P&G. The detergent in your laundry room? Probably Tide, P&G again. The sodas in your refrigerator? Coca-Cola or Pepsi. The groceries in your pantry? Purchased at Walmart or Costco. Consumer staples companies surround us every day, forming the backdrop of our lives regardless of economic conditions. The performance numbers speak for themselves. VDC has delivered approximately 12% annually over the last 5 years and around 8% annually over the past decade. While these returns don't match high-flying tech stocks during bull markets, they demonstrate remarkable consistency through all market environments. For an alternative option, XLP, Consumer Staples, Select Sector SPDR Fund, offers similar exposure with a slightly different weighting methodology. During the 2008 financial crisis, when the broader market collapsed by over 50%, consumer staples stocks declined by only about half that amount and recovered much faster. The same pattern emerged during the COVID crash. These essential businesses kept operating, while discretionary companies shut down completely. For most recession-conscious investors, I recommend allocating 10 to 20% of your portfolio to consumer staples ETFs like VDC. This provides meaningful protection without sacrificing too much growth potential when markets recover. ETF Category 6. Utilities ETFs. Even in the darkest economic times, the lights stay on, water flows, and the bills get paid. Utilities represent perhaps the most recession-resistant sector in the entire economy for one simple reason. Their services are non-negotiable necessities. When household budgets get tight during economic downturns, families might cut back on restaurants, entertainment, or new clothes, but electricity, water, and natural gas remain absolute essentials. What makes utilities particularly powerful during recessions is their unique business model. Most operate as regulated monopolies, with guaranteed service territories and rates approved by public utility commissions. This creates extraordinarily predictable cash flows, regardless of economic conditions. While other businesses see revenues plunge during recessions, utilities maintain remarkably stable earnings. The demand for utilities like water and electricity is what economists call inelastic. Consumption barely changes even when economic conditions deteriorate. This makes utilities the last expense consumers will cut from their budget in a recession, creating a remarkably stable revenue stream for these companies and their investors. My top recommendation in this category is XLU, the Utilities Select Sector SPDR Fund. With an expense ratio of just 0.08% and a substantial dividend yield of approximately 3%, XLU offers both stability and income, a powerful combination during market turbulence. The ETF contains 31 major American utility companies, focusing on the largest and most established players in the sector. XLU's top holdings include companies that literally power America: NextEra Energy, Southern Company, Duke Energy, Constellation Energy, and American Electric Power. These aren't flashy businesses, but they're essential infrastructure providers with consistent earnings and strong dividend histories. The stability of utilities during economic downturns is remarkable. During the 2001 recession, while the broader market fell significantly, utilities actually gained value. In the 2008 financial crisis, utilities certainly declined, but much less than the overall market, and recovered more quickly. This pattern of outperformance during weak economic periods has repeated throughout market history. The income component of utilities ETFs shouldn't be overlooked. XLU's approximately 3% dividend yield provides meaningful cash flow during market turbulence. These dividends tend to be among the most reliable in the market, with many utility companies maintaining decades-long streaks of consistent or increasing payouts. For an alternative option, FUTY Fidelity MSCI Utilities Index ETF offers similar exposure with Fidelity's cost-effective approach to index investing. The performance numbers for XLU demonstrate its consistency, approximately 10% annually over the last 5 years and about 9% annually over the past decade. While these returns don't match high-growth sectors during bull markets, they've provided remarkable stability through all market environments. For most recession-conscious investors, I recommend allocating 5 to 15% of your portfolio to utilities ETFs like XLU. Combined with the other defensive sectors we've discussed, this creates a powerful recession-resistant foundation while maintaining participation in eventual market recoveries. Now that we've explored these 6 powerful ETF categories, let's talk about how to combine them into what I call the recession resilience portfolio. The key is not just owning these ETFs, but holding them in the right proportions based on your personal risk tolerance and time horizon. For someone with moderate risk tolerance preparing for a recession, here's a sample allocation model that combines all 6 categories we've discussed. 10% in gold ETFs, IAUM or alternatives, 20% in dividend ETFs, SCHD or alternatives, 25% in all-weather ETF, ALLW, 20% in short-term bond ETFs, VBIL or alternatives, 15% in consumer staples ETFs, VDC or alternatives, 10% in utilities ETFs, XLU or alternatives. This balanced approach gives you multiple layers of protection. Inflation hedging from gold, income from dividends, broad diversification from the all-weather ETF, stability from bonds, and recession-resistant earnings from consumer staples and utilities. Together, they create a portfolio designed to weather significant market turbulence while positioning you for strong recovery when conditions improve. The timing question is one I hear constantly. Should I make these changes all at once or gradually? My strong preference is for dollar-cost averaging, making regular, systematic purchases over time rather than trying to time the perfect entry point. Fear and timing rarely mix well in investing. By systematically building these positions over 3 to 6 months, you reduce the risk of making a major allocation change at exactly the wrong moment. The biggest mistake I see investors make during recession fears is either doing nothing or making radical changes based on headlines. The approach I've outlined today is neither passive nor panicked. It's strategic repositioning based on historical performance during economic contractions. Remember that recessions, while uncomfortable, are temporary phases in the economic cycle. The average recession lasts approximately 11 months, while the average expansion lasts about 67 months. By building a portfolio that can withstand the relatively brief downturns, you position yourself to fully participate in the much longer growth periods. I've personally implemented these exact strategies in my own portfolio, gradually increasing allocations to these defensive ETFs as recession indicators have flashed warning signs. This hasn't meant abandoning growth entirely, just balancing it with protective assets that historically shine during challenging economic periods. The financial storm clouds gathering on the horizon don't need to be a source of fear, not when you have the right investment umbrella ready. By strategically positioning your portfolio with these recession-resistant ETFs, you can transform market panic into long-term wealth creation opportunities. If you found this approach helpful, make sure to subscribe for next week's follow-up video, where I'll show you exactly how to rebalance your portfolio when the recession actually hits and identify the perfect time to shift back toward growth as the recovery begins. What's your recession strategy? Share your thoughts in the comments below and let me know which of these ETF categories you find most compelling for the current economic environment. Remember, while others panic, strategic investors prepare. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.